I enjoy coming to work every day knowing that clients are depending on me to guide them through whatever financial needs they have.
Every client we have is different. And so it's really about finding out what's really the most important thing per client.
With financial planning, everything is interconnected. So a comprehensive plan means that you're taking care of income needs now, income needs in the intermediate term, and income needs long term. We'll do an asset cycle portfolio. We'll do a riskalyze test. We'll do a life insurance audit or a life insurance review.
And so when we build a deep relationship with our clients, then we can take a step back and then we can look at different options to help them specifically get to their goals. One of the things I feel our job is as advisors is to introduce strategies to clients that maybe they did not know that they were out there. But it's our idea, our job to come out and say, have you ever thought about this?
And the planning it's not always about income, but a lot of it is also about the legacy. So the element of family is very important to us, and it's important to our clients.
Hello, my name is Steve Jablonski, host of Financially Speaking with Jeff Bush. Today's topic is a very interesting one, following up a year of 2018 when asset allocation strategies didn't work for people. Today we're going to be talking about what are some of the other choices and alternatives people can use to be successful in investing. But before we do that, I'm going to turn it over to Jeff to tell us about, we've had a very exciting year in the news in 2018.
Well, hello, Steve, and welcome to the show, and Happy New Year and all that. It's great to be here on PCTV. We're actually in our 6th year of programming here on PCTV. Really hard to believe, but it's been a great partnership, and we're really excited to be doing this show here on the network. 2018 was a very interesting year in a lot of respects. Really, all the asset classes were down for the year, and that can happen. I think the last year that happened was probably 2008, so 10 years ago. So I think the important thing is just having the discipline of investing, which we're going to dig into a little bit here today. But last year was really an exciting year for our firm in that we got published quite a bit. I wrote an article for the Reading Eagle, and also a couple different articles for Kiplinger. In addition to that, Steve, you were featured in the Norristown Patch. I was interviewed on Enterprise Radio, and our partner and colleague Barry was quoted in Investopedia and Yahoo News. So really just a lot of good things going on. So that's really one of our objectives here at the firm, is to educate and get and really get the word out, and that's why we do this show, because we feel it's really important to get our information out there.
That's great. That's really important. So Jeff, when we talk about asset allocation, basically what is it? How does it work? Why do people use it?
Well, asset allocation is really used to it's really a tool to not to measure your risk, but to invest your assets in a way that's consistent with your risk portfolio or your risk tolerance. And it's really a mixture of stocks and bonds and cash and real estate and all these other kind of non-traditional type investments. And what was kind of interesting and fascinating, if you will, is when you look at 2018, it was really a year of extreme volatility, particularly in the stock market, and that was marked by, particularly in the fourth quarter, where we had a significant drop in the market indexes that we follow. And of course, the bond market was affected by rising interest rates, and the real estate market too, to a certain degree. So it was a tough year. Really, there was no good place to hide. Now if you were in cash, that was probably the one asset class where you at least made a little bit of money, and interest rates started to go up a little bit and move off of the extremely low rates that we've had for so long. So it was an interesting, and in a lot of regard, it was a tough year.
And so with asset allocation, some of these they react differently in certain markets. So like some of them are inverse, or how does that work?
Well, I mean, if you have, there's a lot of it is we use negative correlation, meaning that a lot of times these asset classes move in opposite directions, but that's not always the case. And a lot of we had a double whammy this year in the market, in that a lot of the reason why the stock market was volatile and the stock market ended up being down was because interest rates started to creep up, and with the creeping up of the interest rates, that had some adverse effect on the bond market. Really, I think what happened is interest rates have been held down artificially low for such a long period of time, basically just to keep our economy going.
Sure.
And Steve, if you look at some of the economic data that we study, the economics look good. Employment is good. Jobs are good. Housing's good. The economic data is generally pretty good, but the markets are very reactive to a lot of things that happen.
And we talk about what is an equity, what is it? Is it more volatile than a bond? How does it differ from a bond?
Yeah, it's more volatile than a bond. So stocks are more. So if we would look at and I don't think we have a graph today, but if you would look at a graph of the stock market over time, we just look at the last 20 years since the turn of the century, you'd see a very volatile chart. A lot of ups and downs. Two bad recessions. Two of the worst recessions in our history, you could argue, and then of course we had a strong growth market in the equities over the last 10 years. So a lot of volatility. The bond market is not going to have that kind of volatility. If you look at a trend line for bonds, it's going to be a more stable investment, and that's why it's important to have an allocation of bonds in your portfolio.
And so when we talk about it, a lot of time we refer to it's not your father's stock market. What does that mean to us?
Well, we like to say it's not your father's stock market because if we look at your father's stock market, which we define as the 80s and the 90s, where the market was just going straight up, there was very little downward movement. There was some, but not much. If we look at that 20-year period of time, it was like you're averaging a very strong double-digit, probably 17% rate of return over that period of time. It was a period marked by strength in the stock market. So that we always say that's your father's stock market, meaning that was the stock market of a generation ago. The stock market of today is very different, where buy and hold strategies don't work because of the extreme volatility. And then if you mix in that with the fact that maybe your time horizon is compressed, if you're, we work with a lot of people that are in their, their 50s and 60s or 70s, and you maybe don't have a lot of time to recover from volatility in the market. Now, if you're talking to somebody who's 20 or 30, they have a lot of time. Yep. So there maybe buy and hold does work, but it's more like buy and pray.
Right. It's so for people that don't want to try to employ asset allocation or maybe don't know how to do it, what are some other strategies or options that are out there?
Well, yeah, I mean, we have a lot of strategies that we employ in our firm, and one of the things that we use is we use annuities in a lot of cases because with annuities can offer a lot of protection and a lot of safety and some guarantees depending on the product. And of course, there's a lot of different flavors of annuities. There's fixed annuities, there's fixed indexed annuities, there's variable annuities, and of course the variable annuities do have volatility. They go up and down with the markets. There may be some guarantees provided in there for income benefits or even death benefits, but you still have a volatile investment. You still have to really be aware and know that you can lose money as well as make money in those types of investments. The fixed accounts, the fixed annuities, and the fixed indexed annuities, there you have more protection to your principal, and you give up some of the upside return in those products, but they offer a lot of safety. So we use that as a tool to couple with some of our other strategies that are exposed to the market.
And so with an indexed annuity, what is the growth based on, as far as that goes?
Well, it's based on an underlying index.
Okay.
I mean, that's where we get the name index annuity because the growth is tied to an index. It's generally a stock index, but it could be a dynamic type index where it's a balance between stocks and bonds. And of course, it used to be, and these products are now, I remember when they first came on the scene like 20 years ago, and they've evolved quite a bit since then. It used to be, it was just the S&P 500 index, and now they've got all kinds of indices that they use to track, and some of them, Steve, have done pretty well the last couple of years when the stock market was way up. But now, now we're seeing, that in the latter part of 2018, we saw, a lot of clients came up with a zero on their account balance, which is good. And I shouldn't say account balance; I should say the performance for the year, because the markets were down. So if the stock market, let's just say the broad stock market is down 10% over a period of time, your index may return zero.
Yep.
So, in that example, you just beat the broad market by 10%, because you didn't lose 10%. You stayed flat. So that has a lot of appeal to some investors, and for a lot of our clients, we use that as one of our strategies of, we usually when we put together a comprehensive plan, we're using a lot of different strategies, and that could be one of them. Yep. And of course, the same thing can be said about the index annuity, flipping back to that. That has a reset feature where, usually you have like a 1-year strategy. There's index annuities that have multi-year strategies, but let's just say for discussion this morning, we're working with a 1-year strategy. And you have a bad year in the stock market, and your index comes up with a zero. The slate is then wiped clean, and then the next year you're starting from zero rather than the minus that the index had. That's called reset. And I should say, Steve, these products are tricky. They're really, really tricky, and they're hard for us to understand, and they're hard for consumers to understand. So, I should say, for any of our viewers out there, if you're interested, this is really something that involves a very deep discussion. It's not something that you're just you want to go out and buy without completely understanding the ramifications of getting into this product, because it's offered by an insurance company. There's usually a time commitment that you have to make, whether it's 5 years or 7 years or 10 years or even more. You have to understand all that, and it's not the most liquid investment, because there's liquidity restrictions on there, and that's why we create other accounts where we can get liquidity, and we generally are using these for more longer term strategies. So there's really there's a lot to consider, and to try to compress it all in this format of this show here today is that we're just trying to kind of give our viewers a flavor of there are products out there, there are strategies available where you can participate in the market and not take as much market risk as if you were just in a pure equity strategy.
And so today we talked about some alternatives for asset allocation. How do these couple tools that we talked about, how do they fit in the financial planning at Informed Family?
Well, I think the first thing is that we do is when we sit down and meet with our clients, we really try to get to know them quite a bit, and we find out what their goals and objectives are. We find out obviously how long are you going to be working, what are your sources of income, and then we go through a whole risk analysis, which that's kind of your expertise, the whole risk software, and we find out what their risk tolerance is. And it's like baking a cake. There's a lot of ingredients that go into this. So we plug in all these factors, and then in the end there's a comprehensive plan that's generally involves many different investment strategies. And the investment strategies really involve what I'll call asset cycle. So it's investing over a timeline, and that in itself really helps to manage the risk and the volatility, because when we have assets that are really dedicated to a long-term strategy, we can afford the volatility. And even if we look back at 2018. And by the way, what's really fascinating about this is our phone doesn't ring when the market goes down. We fielded very few calls, in the last several months of the year. We didn't really get a lot of, we don't get a lot of panic type calls, because we have people, in plans and strategies where we know there's going to be volatility. I mean, what happened in 2018 didn't come as a surprise to us.
Yeah. And I think a lot of that has to do with how the company's set up, suitable versus fiduciary versus suitable.
Yeah, so that's true. When you are operating in a fiduciary capacity, which we do and have always done, you're acting in the best interest of your client. So it's a different level than merely being suitable. Suitable just means the investment is suitable. Okay, it doesn't mean necessarily that it's the right investment for the consumer. That involves a whole other level of diligence and a whole other level of planning, and the fiduciary capacity, and that's really. It's kind of taken hold in the media the last couple of years, particularly with some of the legislation that's been going on. But for us, I mean, that's always been how we've operated, because we come from a place, and of course, Steve, you're a CFP. I'm a CHFC, so both are designations where we're doing financial planning, but. More important than that is the licenses that we hold, which where we're operating in that fiduciary capacity, and that should be really a really important factor with consumers, because it's our job to find out the goals and objectives of our clients, the risk tolerance, and then put a plan together that's consistent with those goals and objectives.
And I believe with the fiduciary setup and with being independent, that's a really good fit. Can you tell us a little bit about how that? Yeah,
so we are independent, which means that we have access to a lot of different things, a lot of different products, a lot of different services, and that gives us the ability to act in a fiduciary capacity. We're not tied to a great big insurance company. We're not tied to a great big wirehouse or a bank. We basically work for our clients. So the independence and what's really interesting and fascinating about that is both of us have have backgrounds, and we came from shops where that was not the case, where we were in more of a captive type environment where we were kind of steered to certain stuff, certain products, certain insurance products. And when you go and make that move to becoming independent, I mean, it's a world of difference, and it really opens up your eyes, and it really allows you to act in that fiduciary capacity.
And as far as when you meet someone for the first time, and maybe it's a referral or a recommendation from someone, what does that first meeting look like? How's the process work?
Yeah, so it could be a referral, recommendation. It could be somebody that came to one of our workshops. And, the process is, we generally go through, we used to call them fact finders. Now we call them personal manager reports. But it's basically a process where we're finding out what it is, where they are and what their goals and objectives are. I'd like to find out, what is it that you want to do? Where do you want to be in 3 years? What has to happen for you to be successful? We ask a lot of questions. It's a meeting where we're asking a lot of questions, and hopefully the people that we're sitting across the room from, they're asking a lot of questions too. It's really a get-to-know-you meeting. We want to find out where what their goals and objectives are. So it's an extremely important part of the process, because that's where we start to formulate the overall financial plan.
And in 2018, you were published with an article about how retirement is different now with Social Security, pensions.
Yeah, it's not only your father's. It's not your father's stock market. It's not your father's retirement either. Retirement today is very different than it was, again, a generation ago, because the pensions have, by and large, gone away unless you're working in the public sector. Most people don't retire with a pension, so it's got to be self-directed. So, when you're retiring, that means you gotta have a handle on all the risk that's involved with having these great big 401k accounts, these great big retirement accounts. It can really be overwhelming, because most people aren't equipped to make all these important financial decisions that they have to make. And that's the capacity that we operate in.
Yeah, and a lot of time retirement gets compared to the second half of the game. What's your philosophy on that?
Well, the second half of the game is different than the first half of the game. You're operating from a different vantage point. So, in the second half of the game, we're presuming that you're winning the game. You're ahead. So, if you're losing and then you're in the second half, that's not a good place to be, because you got to do things that are desperate, and we don't want to do that. But if you're winning the game, then your strategies are very different. So, what's an example of that? Well, in the first half of the game, you might be growing your portfolio. Your focus is on growth. Okay. In the second half of the game, it may be you're trying to preserve capital, you're trying to generate income, maybe you're trying to generate guaranteed income. So the focus is different. So you can't play the second half of the game like you play the first half of the game.
Right. And the company has some workshops coming up. Why don't you tell us a little bit about that?
Yeah, so we take the show on the road. We do public we go to public venues. We up on a screen there, you'll see where we're going to be. But this year we're going to be doing workshops, Steve, where we're going to either talk about Social Security, we're going to be talking about retirement. We have some IRA seminars coming up. We have really a lot of exciting stuff. So if you really are, we're really all over the place. So we're all over Montgomery County, Chester County, even down into Philadelphia. So if you're interested in any of our events, give us a call. We can hook you up. we can get you tickets to our show, to our workshop, and it's really a good learning experience. So this is a good show today. It's a good way to kind of kick off the year because 2018 was a very volatile year in the market. We don't know what 2019 holds for us, but we could be in for some more volatility. So it's important if any of our viewers are interested, give our office a call and we can sit down with you and go over your own personal situation and help guide you into a secure retirement. So with all that being said, this is Financially Speaking with Jeff Bush.